All right, guys, welcome back to the channel. Just want to thank you for following. I've actually crossed over 1,000 subscribers. I think I'm over 1,200 now, actually, so really appreciate that. In today's video, what I want to talk about is an option hedge that I put in this morning. So for those of you who follow my Seeking Alpha essays and follow my videos here, you know, I'm a big proponent of leverage ETFs, which puts me in the minority. Many people have the attitude, run, don't walk from leverage ETFs, that they're only suitable for day-to-day trading. I very much have a contrarian, independent view on that, which differs from many certified financial planners, CFAs, portfolio managers, so on and so forth. If you're really interested, and I can link it in the description, I wrote an essay many years ago, leverage ETFs for the long term on Seeking Alpha. You can pull that up. And so let's get into the specifics here, and I'll tell you how this whole came about. So you see here, and I have it, I'm going to put the cursor on it. You see in 2017, it was August 8th of 2017, I made my first purchase of TQQ. Okay. You can see then on 8/14, 9/1, 9/19. The last purchase in 2017 was October 26th. Then we get into 18 and 19 where there's some small dividends that shot off. So my cost basis on TQQQ is $39.19. That today is worth $29,386.35. So I have a gain of $25,466.41, which is a 649.66% return, which is insane. And actually looking at this, maybe I made the wrong decision of doing this hedge. You know, I'm looking at a Ford Maverick. Maybe I should just sold 100% of this and just walked in with 25,000 and bought my Ford Maverick in cash. But that's a different story. So let's get back to this. So I'm looking at this, and in a video I did the other day, you saw that the market is overvalued from multiple angles, from different ways you can look at the market. And I'm not one of these market timers. So if you turn on financial media, CNN, NBC, or Bloomberg, or even YouTube, you know, the next crash is coming, beware. And you'll see all these soothsayers, these tarot readers, if you will. Reminds me of in a way, the old Greeks, a lot of the Byzantine Orthodox Greeks read the coffee grinds to tell the future. So you'll see people on YouTube reading the coffee grinds, telling the future of the market. I'm telling you, I have no idea when the market is going to decline. That's just not the business I'm in. Okay. But, and I pulled it up on another video, but let me pull it up again here. And this is on multiple websites. So we're going to shift screens. This is the S&P 500 PE ratio. It's 34.9. The mean and median is 15.95, 14.86. So again, even if you adjusted that, you brought up, let's say the new sort of flatline mean median is 18 or 20, you're still at 34.9. We're going to go to the Cape Shiller PE ratio. 38.63, almost as high as the dot-com bubble here. So the mean is 16.85, the median 15.85, the max is 44.19. We're at 38. So we're nearly at the all-time max of the Shiller PE ratio. And then you look, I'll show you one more just valuation, because I don't want this to be a valuation video, but I just want to show you my thought process of why I put in this this hedge. Price to book value 4.77, you know, 2.78, 2.89 mean and medium. The max again is 5.06 in March of 2000. So we're approaching that 1999 2000 range of valuations. So I said to myself, I'm looking at TQQQ here. So I'm saying, okay, I could sell today and walk away with $30,000, right? So again, I can then, keep that in cash. I could go buy my Ford Maverick in cash. I maybe put it in what I would see as an undervalued asset, though there's less and less undervalued equities. And there are some certainly, but we're in a very rich market. And then I thought, you know what? Let me put on a hedge. And here's what I did. So we're going to go to another video. So you can see it's trading at 146. So we're going to look at what I did here. Coming down here, you'll see this morning at 9:35, I sold one TQQQ, June 17th, 2022, 170 call for 19.35. So I made 19.34 and 33 cents. Okay. Notice I put it out a long duration to June of next year. So many, many months away. I immediately took that free money and bought one TQQQ, June 17th, 2022. So the same expiration, 115 put at 19.15. So it's almost an exact swap of premiums. I think I maybe pocketed $15. And why did I do this? Well, let's take the call. So what'll happen here, and I always do worst case scenario things. So it's trading at 146 today. If the market goes up to 38,000 and TQQQ goes to 200, the downside is I'm a forced seller at 170. So I miss that 30 upside, right? I missed that $30 upside, the upside between 170 and 200. But I lock in a gain. I guess, I'm at a $24,000 gain. Maybe at that point, my gain will be, I'll lock in a $32,000 profit. Maybe that profit could have been 36 or 37, but I lock in a profit with one, and I still have the other 100 shares, which are going to go up if that were the case. That's only 100 of the 200 shares that I own. And then I bought with that premium the TQQQ 115. And why did I do that? Well, let's say there's a massive market crash in the NASDAQ or just a general market crash between now and June 17th. TQQQ, instead of trading at 145, could trade for 80, 60, 40, 20. In fact, if you look at right here, if we go back, my cost basis in 2017 is $18.82 on August 8th, 2017. So let's just say it goes back to where it was in 2017. The last, 4 years or so of gains are reversed. Okay. Well, this premium, instead of being worth, let's say, $1,900, might be worth $6,000, $7,000, $8,000. Or even if I held it to the expiration, let's say we're trading at $18. Okay, pull this up here. And I'm able to sell at 115. So you take 115 minus 18. That's $97 of profit per share, okay? Times 100 shares. So that would be $9,700 I would make on that, which would be, almost $10,000. So in a big market crash, when everything else is cratering, this little hedge can make me $4, $5, $6, $8, $10,000. Again, when I'm hemorrhaging hundreds of thousands, it's not necessarily gonna stop the whole market crash, of course. But the advantage is if I make that 5,000, what I could do is I could then buy whatever has fallen the most in this particular market crash. It's how I made a fortune in March of 2020 if we go here, again, and I always kind of show this, I don't necessarily do it to brag. I do it as a point of learning for myself and those watching this channel. But you can see how I totally gamed the system here. I was at 363. I fell, 203. What's that? Over 150,000, whatever the math is, 160,000. But look what I did, because I was buying here. I was buying it in March, April, May. I was buying on the option premium I was collected. I was reinvesting dividends, and now we come out and boom, I'm way above 363 in this account. I'm at 640. So that's what the idea would be, on this hedge, is if this hedge nets 5 or 10,000, I might buy whatever sector, and it might be TQQQ, it might be UDAL, it might be hotel industry, it might be oil and gas, it might be banks, whatever it may be. I might take that whole 9,000 and buy something that's trading at low valuation. I think it's under its book value. So this is a very, I said it to my friend Logan Kane today. This is like kind of a very Carl Icahn play, this kind of hedging. And, that's, I really got into options because I was studying Icahn a little bit several years ago. And I'd studied a lot about investing, but I didn't know much about options. And I said to myself, if I want to be in the 1% of investors, if I want to be a super investor, a 15 to 30% CAGR long-term guy, I need to master options. I need to. I know it's complicated. I barely passed calculus in high school. In fact, I was getting a D-, I think, in calculus. I couldn't figure it out. So it's kind of like, I'm not a math science STEM guy. I'm a humanities guy. But I was just like, I watched every video I could, did a lot of different, books and videos, and just tried to really understand it. And it's really served me well, because a lot of these gains are due to the option premium I've collected and reinvested. So this is one of the first times I've actually done a hedge. Normally I just sell puts, cash secured puts and covered calls, take the premium, buy stock with it. This is the time I actually put on a sort of sophisticated, if you want to use that word, type of hedge. So so that's pretty much it for today. So you can see, so we'll know, you can follow it. You can see, today's date, or the Thursday, September 16th. So come June, we'll know that, what happens. Now, let's say the stock market stays where it is. If we're flat, well, then nothing really will happen. It won't get called away at 170. I won't be able to take advantage of the put side, but it was a free insurance policy because I just sold the call. Now I could have gambled a little bit. I could have sold that call if we were flat and taken that $2,000 or $1,900 and then bought more TQQ with it, or bought something else. But I used that premium for the insurance policy of buying puts, or buying a put. So, all right, guys, that's pretty much it for today. Again, thank you so much for the follows, over 1,200. Closing in on the 4,000 hours of watch hours. Hopefully we'll be monetized soon. Take care. Happy investing. Ciao.